Hi, I'm Ashwin with over 12 years of experience in catastrophe modeling and reinsurance analytics. In this PPT, we will discuss the reinsurance capital and various sources of capital available in the market, such as traditional and non-traditional capital. We will discuss each of traditional property cat reinsurance programs being operated in the market as can be seen. Towards end of the PPT, we will go through reinsurance program structures of insurers, which will help summarize each of the traditional programs that we will discuss shortly. Let's start discussing each of these. As we all know, people like us, global corporates, industries, and many other institutions would like to secure properties from catastrophes and explosions. We transfer the risk to insurers and pay a premium as fee. Insurers or insurance organizations reinsure the risk so as to remain solvent, increase capacity. In the process of insurers reinsuring the risk is called reinsurance. Now, how do insurers obtain reinsurance? There are two sources to access reinsurance capital. First is accessing traditional capital, and the other way is non traditional, also known as alternative capital. Let's look at what is traditional capital. Traditional capital is the oldest and widely used to access reinsurance, and it forms part of regulated market. The traditional reinsurer's main source of revenue is by receiving premium, by reinsuring the risk. They are here to stay with whatever the market conditions may be. Examples of traditional reinsurers are Swiss Re, Munich Re, or for that matter, any other reinsurers across globe. They all form part of traditional reinsurers. Now let's look at what is non-traditional or alternative capital. Instead of accessing traditional market, if insurers access financial markets, then it is called alternative capital. From the financial markets, leading hedge funds, mutual funds, wealth funds, and also pension funds invest in reinsurance. This form of capital came into existence after Hurricane Andrew in 1992. Since then, it has grown consistently over the decades, and this part of capital forms part of unregulated market. Now, why do financial markets invest in reinsurance? Since the rate of return is attractive. If if the rate of return decreases, and since this form of investing in cat reinsurance is not their primary source of revenue, their existence in challenging market conditions to provide reinsurance market or capital is always a question mark. Now that we have discussed traditional and alternative capital, let's look at the total capital available. As you can see, we have a decade long data for global reinsurance capital. As on Q1 2021, about 650 billion of total reinsurance capital is available, out of which about 400 billion pertains to catastrophe reinsurance. The rest 250 billion comes from other focused LOBs such as liability, life, accident and health, and casualty. Out of 650 billion, about 85% or 554 billion comes from traditional reinsurance market, which is the dominating market. And the other 15% comes from alternative. Within alternative, again, there are four types: catastrophe bonds or cat bonds, sidecars, industry loss warrants, and the collateral reinsurance. As can be seen, collateral reinsurance and cat bonds are most widely used classes of alternative reinsurance. Please note that insurers' reinsurance programs can also contain a mix of traditional and alternative capital, which we will discuss towards end of this video. Now that we know the sources of reinsurance capital, let's focus on understanding various traditional property catastrophe reinsurance programs that are being operated in the market. As can be seen, based on insurers' critical zones, exposures, line of business, geographical reach, it can purchase any of the seen programs or consider all of these as part of its reinsurance program. We will discuss each of these in greater detail. Reinsurance can be broadly classified into two types: facultative reinsurance and treaty reinsurance. Facultative reinsurance are reinsurance sessions individually agreed upon due to them being unique and expensive exposures such as large industrial units, art galleries, etc. Coming to treaty reinsurance. Treaty reinsurance are written on insurer's complete book of exposures. The traditional reinsurance programs that we discuss form part of treaty reinsurance and will be our prime focus. There are two classifications of treaty reinsurance: proportional reinsurance and non proportional, also known as excess of loss reinsurance. Let's start with proportional reinsurance. Proportional reinsurance are risk level treaties, and the terms and definition of what forms a risk are predetermined in the reinsurance agreement. Usually, in proportional treaties, risks are at location or at policy level. There are two types of proportional treaties: surplus share and quota share. Coming to non proportional or excess of loss, it contains both risk level and event level treaties. Risk level treaty in excess of loss is called per risk excess of loss, and the event level treaties are called catastrophe excess of loss or aggregate excess of loss. Now, what is the difference between risk level and event level? With respect to the event level, the individual location and policy level losses are accumulated for entire book, which is also known as portfolio, after which event level treaties are applied. Let us understand each of these treaties and their usage. Starting with proportional reinsurance. As we have discussed, there are two types of proportional reinsurance: quota share and surplus share. Let's discuss quota share first. Quota share treaty is a part of proportional treaty contract where the insurer and reinsurer share sums insured, premium, and losses according to a fixed percentage. For example, say for a risk, sum insured is 100k, premium is 1k, and losses are 10k. And if it is a 70% quota share treaty, it would mean that reinsurer assumes 70% of the total risk, and 30% is taken by the ceding company or the insurer. As you can see in this example, based on 70% quota share, reinsurer assumes 70% of sums insured, premium, and losses, and the remaining 30% is considered by the insurance company. Sounds simple, right? So, now that we have completed quota share treaty, let's understand what could be its advantages. Quota share treaty is easy to administer as accounting is straightforward and its calculation is simple. It is often used by new companies entering the market for the first time, or probably entering a new line of business or a new area of operation, especially where it has little or no experience. There is no selection of risks as such, and hence reinsurer gets proper mix of business, as insurer is obliged to cede or transfer every risk falling within scope of the treaty. It cannot choose to cede only poor quality risks. And what could be a potential disadvantage of quota share? Insurer cannot select the risks it transfers to reinsurer and must cede all risks which lie within its financial capability. That takes us to another proportional risk level treaty called surplus share, that is an answer to this limitation. What is a surplus share treaty? Surplus share treaty is a part of proportional treaty contract where the risks covered are those whose sum insured amount exceed a retention, which is also called as a line. The limit of surplus share will be in multiples of lines. The premiums and losses are shared in the same proportion as line amount to the sum insured. Say, for example, sum insured is 30k, premium is 1k, and losses are 5k for a risk. Since the sum insured is 30k, which is higher than the retention or line, which is 10k, the seeding company takes first 10k or retains the first 10k, and the reinsurer retains the remaining 20k. Upon calculation, that comes to a share of 33% to the insurer and 67% to the reinsurer, as can be seen in this slide. And the premium and losses are calculated with the same share percentage. Now, there is a chance that insurance company can retain more lines based on the risk. As you can see in risk 2, the seeding company or the insurance company has retained 3 lines. And going by this example, if the sum insured is 50k, premium is 7K and losses are 9K. Seeding company, since it retains three lines, meaning 10K multiplied by 3, which is 30K. 30K is the seeding company's retention for this risk, and the remaining 20K goes to the reinsurer. So calculating the share, it comes to 60% for insurance company and 40% for the reinsurer. And the premiums and losses are also calculated in the same way. Let's look at advantages and disadvantages of surplus share. As we have seen, surplus share treaty provides advantage to control the size of retained liability for individual risks. And this selection of risks will act as disadvantage to reinsurer, as insurer retains more lines for good business and cedes high proportion of less desirable risk to reinsurers. And also, since there is element of calculation that is involved, it increases the cost of administration as percentage distribution of each risk can be different. Now that we have discussed proportional risk level treaties, let's focus on excess of loss reinsurance now. In proportional reinsurance, we have seen that insurer cedes a part of risk, but in excess of loss, the reinsurer agrees to pay the amount of loss over and above a certain amount called retention or attachment point. Reinsurer pays up to the limit. Excess of loss treaty provides cover on a per risk or event, or also known as occurrence level basis. As you can see in the first chart, there is insurer portion and there is reinsurer portion. The insurer takes care till the retention, or also known as deductible or attachment point, and above deductible, the amount up to the limit will be taken care by the reinsurance. And the same approach to be followed for event level reinsurance structure at the bottom. As can be seen, we have quota share treaty and the rest are all catastrophe excess of loss treaties. We have layer 1 through 6 with various limits and attachment points. For example, if we consider layer 1, which is 20 million excess 20 million, say if loss is 40 million, the first 20 million, which is retention, will be taken care by insurance company, and the other 20 million, which is up to the limit, will be taken care by the reinsurance company. So here, since the percentage placed is 77%, so 77% of 20 million limit will be taken care by Cat XL reinsurer, and the remaining 23% of 20 million limit will be taken care by quota share reinsurance company. Note that this structure provides up to 865 million of coverage. So the Cat XL treaties are widely used by insurers against very large events. Let's look at the advantages of excess of loss treaty. The insurer obtains protection only against large losses that could strain its financial capacity. Hence, it increases the amount of premium retained as reinsurer is not involved in most frequent small losses below the deductible. And the administration is also much simpler when compared to the proportional treaties. Now, again, coming to the structure, you can notice that we have something called prepaid, 1 at 100% reinstatement, and nil reinstatement against few of the layers. Let's understand what are these reinstatements and their impact. What is a reinstatement? Say an event occurs and the reinsurance layer limit is partially eroded. If further any large events occur, there won't be considerable limit remaining with the insurer, right? Hence, insurer when buying cat XOL reinsurance would also like to have reinstatements. Having a reinstatement will help insurer to replenish the reinsurance limit by paying reinstatement premium. Let's understand with an example. Say the layer is 30 million excess 50 million with reinsurance premium, or the amount insurer pays for reinsurance is 3 million. The rate online or ROL is reinsurance premium upon the reinsurance limit, which comes to 10 percentage. Now there are three options which we have already seen in the previous structure. One with nil reinstatements or no reinstatements. The second option is with prepaid reinstatement or also known as free reinstatement. And the third option is with paid reinstatement 1 at 100 percentage. Let's understand each of these options with an example. Layer is 30 million excess 50 million with reinsurance premium, or the amount insurer pays reinsurer to cover this layer is 3 million. Rate online or ROL is reinsurance premium upon reinsurance limit, which comes to 10%. Now moving on to option 1. Since there is no reinstatement, the overall limit available for events to cover the entire contract period is 30 million. Since there is no reinstatement premium that is applicable. Now moving on to option 2. When reinstatement is prepaid or free, the reinsurers charge reinsurance premium by already considering reinstatement. Hence you can notice that reinsurance premium is 4.2 million and rate on line is 14%. Here the overall limit is 60 million. So this automatically provides coverage of 60 million in a contract year. Now moving on to option 3. Option 3 is paid reinstatement at 100%. You can notice that the reinsurance premium is 3 billion, but overall limit is 60 million due to the presence of paid reinstatement. So let's say after a event, if part of a limit or entire limit is eroded, after payment of a reinstatement premium, the limit can be replenished. There are two ways to calculate reinstatement premium for a paid reinstatement. First type is pro rata as to amount and 100% as to time, which is widely used. And the second type is pro rata as to time and 100% as to amount. Let's look at each of these calculations. As can be seen in the bottom table, the contract start date and expiry are from Jan 1 to December 31st. And the layer is 30 million excess 50 million. For event loss of 70 million, loss to layer that reinsurance company has to bear is 20 million. So the reinstatement premium for first type calculation goes as loss to layer, which is 20 million, upon the reinsurance limit, which is 30 million, multiplied by the reinsurance premium, which is 3 million. So 20 million upon 30 million multiplied by 3 million, the reinstatement premium can be calculated as 2 million. So the insurance company has to pay 2 million in order to get the limit replenished. Now moving on to the second type, pro rata as to time and 100% as to amount. Going with the same event loss of 70 million, the loss to layer for a reinsurance company is 20 million. So 20 million upon 30 million multiplied by 3 million, and with additional time aspect to be considered. Since 184 days are remaining for contract to expire, the second type reinstatement premium calculation goes as loss to layer upon reinsurance limit multiplied by days remaining in the contract to expire upon the total number of days in the contract multiplied by reinsurance premium. So this way of calculating provides the reinstatement premium as 1.008 million. So this is the amount that insurer has to pay post event to replenish the limit. To summarize this slide, we have nil or no reinstatement, for which obviously there is no reinstatement premium to be paid. If it is a prepaid or free reinstatement, there will be an automatic replenishment post event without any reinstatement premium, since the reinstatement premium has already been considered as part of reinsurance premium. If it is paid reinstatement, we need to pay premium post event to replenish the limit. As you know, we have seen in this example the reinstatement as one. If insurance company finds it necessary, they can also consider two or three reinstatements accordingly. So for example, if they consider two reinstatements, and if its original limit is 30 million, and since reinstatements are 2, 30 multiplied by 2 will give us 60 million, and the original limit of 30 million. So overall the limit will be 90 million. This is about the reinstatements, its role, and its impact in cat XOL treaties and its calculations. We discussed about cat XOL programs and impact of reinstatements. We also discussed that only for paid reinstatements, insurer needs to pay reinstatement premium after the event to have the limit replenished. Imagine a scenario where a large event occurred and the insurer has to pay reinstatement premium to replenish the limit, and this could be a possible burden during these times. We have reinstatement premium protection RPP program that acts as a protection to reinstatement premium cost in case of loss to original excess of loss program. Let's look at an example. We have layer of 30 million excess 50 million and event loss is 70 million. It has one paid reinstatement with reinsurance premium of 3 million. The net due from reinsurer will be 18 million. So the calculation goes as 20 million from catextual reinsurer and then 2 million reinstatement premium that insurance company has to pay. So the net due from reinsurance company will be 18 million. So having a reinstatement premium cover, the 2 million will be taken care by the reinstatement premium protection program. So note that only for paid reinstatements, reinstatement premium protection program will be applicable. Now let's look at what are the advantages of reinstatement premium protection RPP program. It's a cost effective program, right? Usually insurers have limited reinsurance budget. If they have budget available, they may choose reinstatement premium protection as a cost effective product. RPP avoids burden of reinstatement premium as installments spread over time as defined in RPP cover. In several markets, reinsurance premiums are tax deductible for insurance companies, as the state also has interest in protection of insurance companies. However, reinstatement premium payable by insurers after a loss are not always tax deductible. Hence, buying RPP at the beginning can result in tax advantage. So now we all know that cat-XOL treaties, the reinstatements, and the RPP are based on cat-XOL treaties. Now, what if there are multiple events in a contract year, and the event losses are much smaller than attachment point of layer one of cat-XOL treaties? So the second, third, or fourth event covers are answers to such questions. Let's consider an example. Say per occurrence program layer is 50 excess 45 million. Notice that second event cover layer is 50 excess 45 excess 45. This means that for second event cover to take loss, first event loss of 45 million condition needs to be met. Further, if second event loss exceeds 45 million, then the second event loss up to limit will be covered. For third event, the layer is 50 excess 25 excess 90. This means that for third event cover to take loss, there needs to be two events with 45 million loss each. And further, the loss should exceed 25 million for third event cover to take loss. Same with fourth event, where the layer is 50 excess 25 excess 115. These covers are especially useful when insurer wants multi-event cover for smaller events. For example, 2005 US hurricane season, wherein we had multiple smaller events as well. Till now, we have discussed occurrence-based treaties by applying layer to the event. In aggregate excess of loss, the net retention of multiple events are accumulated, and on this, the aggregate layer attachment point is applied. If the amount crosses the attachment point, the loss up to aggregate limit is taken care by the aggregate XOL. So we need to remember that aggregate XOL is for accumulated multiple events in a year, while cat XOL is for single occurrence. If mentioned as percentage, it is called stop loss reinsurance. So stop loss reinsurance of 80% excess 70% means that if loss ratio, which is losses and loss adjustment expenses put together upon net earned premium exceeds 70%, the reinsurer will reimburse the insurer above 70%. So say loss ratio is 110%. It means that reinsurer pays 40% and the insurer retains 70%. During soft market, the pricing competition can be fierce between reinsurers. So the reinsurers come up with deals, and one such contract is top drop contract, wherein the reinsurer provides a clause to reuse the top excess of loss layer in the reinsurance cover if retention of the top layer is not breached by the first event loss. It enables the insurer to buy top layers of coverage for a first loss event at a competitive premium, knowing that if top loss capacity remains unused, it will automatically drop down to cover further events. So this results in optimization and also provides flexibility to insurer so that the coverage can either be used for one large event or multiple smaller events. Soft markets are forcing reinsurers to go beyond price reduction to win business. Multi-year contracts help reinsurer to maintain long-term relationships with insurers that can match ILS cat bond products which offer multi-year terms. But by using multi-year contracts, the reinsurers are preventing themselves from benefiting from any price increase or rate hikes. It could also expose them to counterparty underwriting risks. So insurers with most stable insurance portfolios are only considered for this multi-year coverage. For insurers, this results in lessening the amount of reinsurance being placed in the market in any given year, and also it reduces volatility of future reinsurance costs. The last contract in discussion is backup cover. When there is a heightened catastrophe activity, if insurers see a need to purchase a reinsurance program, they consider backup covers. Until now, we have discussed sources of reinsurance capital and various proportional and excess of loss contracts and their usage. Now let's discuss insurers reinsurance program structures and see how various contracts are being used. Starting with assurance reinsurance program. It's a cat XOL program with 80 million retention and reinsurance cover up to 1.245 billion. Looks like assurance purchased reinsurance cover till 1 in 174 year PML. In addition, we can also see Florida Hurricane Catastrophe Fund layer, which adds additional 180 million to a Florida event along with 1.165 billion reinsurance cover. Notice that there is multi-year cover from layer 3 to 6 with 67%. So assurance has reduced volatility of future reinsurance costs and also lessened the amount of reinsurance placed in the market in a year. The remaining 33% of layer 3 to 6 are expiring contracts, which are also known as yearly contracts. Now moving on to Universal Cat Reinsurance Program. We have Cat XOL program, which is the highest ever, with first event coverage taken till 3.413 billion, and it's a mix of multi-year cover and yearly contracts. There is a FXCF layer which again provides additional coverage for Florida events. Here the insurance company has taken second, third and fourth event, since there could be a possibility of multiple smaller events, and the third and fourth events have low retention of 25 million while the first and second have retention of 45 million. Moving to the next slide. All-State Reinsurance Program. As discussed in our earlier slides, the Paragrants program is a mix of traditional and alternative reinsurance. We have Class A and B cat bonds. It also has multi-year and 8-year term contracts and has a coverage up to 6.6 billion. Such a huge reinsurance program with many contracts. Further, there is a aggregate cover with 2.7 billion retention and ILS cat bond cover. Condition of 50 million event deductible is applicable, and another aggregate cover with 4.4 billion retention and 100 million aggregate limit with franchise deductible of 1 million is applicable. Let us see final example, which is QBE reinsurance program. This has three contracts: risk XOL, cat XOL and aggregate XOL. The risk XOL contains quota share as well as per risk excess of loss program. Let's understand risk XOL first. As we know, QB has exposures worldwide and has multiple line of business. Hence, its reinsurance program is much wider in scope. So, moving on to the risk XOL program. So, there is 50% quota share at the bottom, which should inure to the benefit of other programs. And there is main risk XL cover of 250 excess 50. And then there is sub layer of 25 excess 25 excess 75, meaning uh, the attachment point is 100 million, and the per risk limit of 25 million will only be applicable once the loss surpasses 100 million. And there is cyber aggregate section and also class section. Now moving on to the cat XOL. Let's spot various contracts in cat XOL. So we obviously have per occurrence program, and we could also notice top drop cover. So the main cat XOL program is about 2.1 billion excess 400 million, and then there is cat top layer on top of it, and then the highest layer in the reinsurance tower is 300 excess 4.5 billion, which is only for Australia and New Zealand events. And we also have a top layer of 225 excess 2.675 billion, which acts as a top drop cover. So meaning, if the first event loss has not saturated this layer, which is 225 excess 2.675 billion, it drops it drops to 225 million excess 175 excess 225 for worldwide, or it drops for 225 excess 175 for US and non peak Australia. And the rest, we can also see 500 million excess 2.9 billion, which is again a cat top, and this can act as a wrap of 500 excess 400 million for QBE re and syndicate, or it could also act as aggregate with 500 million limit and with 800 million as aggregate retention. And there is a clause of 10 million per occurrence event for this aggregate layer to be applicable. So we have now completed the final part, and that's the end of this presentation. Thanks a lot for your time, and I hope it was useful. Here are my contact details. I'll be happy if you can provide me any feedback, and do let me know if you have any questions.